Okay, in this video, we're going to talk about ratios. So we're looking at Berry Computer Company here, and we've got their balance sheet, and we've got, I did not label it very well, but this is their income statement. For the year ended December 31st, 2018. And so we're going to do some ratio analysis. The problem from the book has the industry average labeled next to it. I took just all the numbers from this and put them onto a spreadsheet to make this a little easier. So the first ratio we're going to look at is the current ratio. So the current ratio is current assets divided by current liabilities. So current assets divided by current liabilities. And what this tells us is just basically how easy it is for us to pay our dues. Okay, it tells us the liquidity ratio. So liabilities are things that we owe, and current means that we owe them within 1 year or one operating cycle. And current assets are things that we own and are either our cash or will become cash within a year. So one divided by the other tells me how much cash I have or how much near cash I have, since it's a current asset, divided by how much money I owe in the near term. So my current assets in this problem, 655,000 divided by 330,000 is my current liabilities. So 1.98. So that means I got roughly 2 times the amount of current assets as I do current liabilities. Notice the industry average is about that. So I'm right near the industry average, which means it's about the same as everybody else in my industry. The quick ratio is a more extreme version of the current ratio. So the quick ratio should always be lower than the current ratio, because quite literally it is the current ratio with some current assets removed. So that means we're removing something from the denominator, which means the number must always go down. So in this case, the current ratio, we're going to take the current assets minus inventories, because that is, some inventories can and can't be turned into cash quickly. So this is just a more succinct or more extreme, I guess, liquidity ratio. So current assets minus inventory divided by current liabilities. Didn't put current in there. Current liabilities. So we got our assets, total current assets minus inventory. Put my parentheses in up here, divided by my current liabilities. So 1.25. So not including my inventory. So that's just my, in this case, it's just my cash and receivables. So my money that I have and money that I'm owed based on my receivables is 1.25 times what I'm going to owe in current liabilities. All right, days and sales outstanding. So this tells me how many days, so the best way to say this, how long it's going to take until I'm approximately going to get paid for what I have already sold. So the ratio is accounts receivable divided by sales divided by 365. So for the number of days in a year. So accounts receivable, 336. I'll put that in parentheses. So I can divide the whole thing by sales, which is down here on my income statement, divided by 365. I just type that number in. So 76.29. So what this tells me is that my days sales outstanding, roughly the number of days that my receivables represent is 76 days worth of sales. So that $336,000 that's in there is roughly 76 days worth of sales on the average. And obviously, you know, things can ebb and flow, but on the average, we just took this as a whole as an entire year. And so there's 76 days worth of sales in my accounts receivable. All right, inventory turnover. Inventory turnover is sales divided by inventories. So sales divided by inventories. So 6.665. So what this number tells me, and by the way, just so you know, the important part of what I'm saying in this video and the important part of what we're learning here is not how to divide two numbers. It's knowing what the number means, knowing what you can do with it, and knowing how to use it. Because anyone can divide a couple of numbers they can find, but to be able to use this for decision making is the important point. So inventory turnover, sales divided by inventory. So how much inventory do I have on hand compared to my sales? So I've got 6.66. So this means that I have, my sales are roughly 6 times, well, 6.6 times how much I have in inventory. What does that matter? Well, that means that roughly a little over 6 times a year, if I ever stopped selling, and we'll do a days one here in a few minutes, I think, but if I ever stopped selling, my inventory would run out roughly 6 times in a year. I'm sorry, if I ever stopped buying inventory, it'd run out 6 times in a year. So I have my inventory represents, 1/6 of all of my sales. Okay, so it would run out, and I could actually take that number divided by, or 365 divided by that number and figure out exactly how many days are in inventory. So if I did this, equals 365 divided by that, 54, that would be how many days I have worth of inventory. So if I stopped buying inventory, it would take me 54 days approximately to run out of inventory. That's number of days sales, number of days in my inventory. Total asset turnover. So total asset turnover is sales divided by total assets. So I've got sales by my total assets. So it's roughly 1.7. So what that number tells me is that assets, remember, all things that I own, and which means they had to come from investment, whether that's investment of money I already made or whether that's investment that I made in the business up front. So that asset number is all the things that I own. I am creating $1.70 worth of sales for every piece of asset, or every dollar worth of asset that I own. I'm creating $1.70 worth of sales from that asset. Okay, profit margin. Profit margin is probably one you might have heard before. Net income divided by sales. Sorry about that. So I've got my net income divided by sales. So what profit margin shows us is for every dollar, for every dollar that we sell, 1.7% of that dollar goes towards my bottom line, which is a pretty low number, honestly. It's a pretty low profit margin. Well, what's interesting is this margin is still higher than what the firm average is. I'm sorry, the industry average is, which is 1.2%. All right, next is ROA, return on assets. So I take my net income. Sorry, this one is return on assets is net income divided by total assets. So equals net income divided by equals net income divided by hold on, I'll pause this. My Excel crashed apparently. Okay, well, my Excel crashed, but we'll continue with what we saw. I lost all this stuff up here, but we'll continue with the ROA. Sorry about that. So ROA is net income divided by total assets. So net income divided by total assets. So we're making approximately 2.8% on my total assets. So this is my investment. This is money that I put into the company or have made, and I am returning 2.8% on those. So for every dollar that I spend, I'm returning an additional, I guess it would just be 2.8 cents, so pretty small, but $1.02 or $2.8, almost $1.03. Okay, ROE, return on equity. That one is net income divided by common equity. So net income divided by common equity, 361,000. So this is how much I'm returning, returning on the equity in the business, returning on my ownership rights in the business. ROIC is return on invested capital, and that one is EBIT times 1 minus the tax rate divided by the total invested capital. Okay. So the EBIT amount, is right here, 70,000. So you take 70,000 times 1 minus tax rate is 40%. Do that part first to get 42,000. All that minus my total invested capital, which should be my common equity. One second. Okay, sorry about that. So the ROIC, the return on invested capital, we've got our formula in here to take our earnings before interest and taxes, EBIT, times 1 minus the tax rate, and you divide that by the total invested capital. The total invested capital is going to be the common equity plus any debt, both long and short term. So that should come out to 0.06, 5.99%. So that is how much I'm returning on my invested capital. Invested capital is money I put in and also money that the company has taken out, because that would also be, I would be liable for that as an owner. So that counts in my invested capital amount. Times interest earned is EBIT divided by interest. So EBIT, which is right, earnings before interest and taxes, divided by interest. So I've earned almost 3 times, but not quite, 2.86 times the amount of money to cover my interest. So that just makes sure I can cover my interest payments on my debt. All right, debt to total capital. So total debt, which is total debt, which is going to be this 84,000, note payable and long-term debt. So 340 divided by the total invested capital. So basically the same thing I did before. let's see if this is right. It's a 0.49. So this one shows me that of the equity in my business, 48.5% of it is debt, and the remainder is equity, is common equity in this case. All right, market to book. Market to book is price divided by book value. So the market price of this stock, it gave it to us, it was 12. And the book price we can find by taking the number of shares, or the value of the equity divided by the number of shares, which should be $10 per share. So my market to book is 1.2. So my value in my stock is 20% higher than what my book value is. PE, one of the most important ratios, price to earnings ratios, exactly like it sounds like, price divided by earnings. So for every dollar, the value, dollar value of stock, the value of the actual stock, then how much is the company earning based on that? So again, the value of the stock was given at 12. And then the earnings, we can use the earnings per share number to say our price per earnings ratio. So 15, I should say price divided by earnings per share. So 15.87. I can't spell the word price today, apparently. So earnings per share. So that tells me, the difference between, so there's a 15, the price of this stock is 15.87 times the earnings for every share of stock. So there's a big difference. So it's only earning 70 cents on the dollar per share, 76 cents on the dollar. And then the price is all the way up to $12. So enterprise value divided by, next is enterprise value divided by earnings before interest, taxes, depreciation, and amortization. So the enterprise value, okay, sorry about that. So the enterprise value, so we're doing the enterprise value divided by earnings before interest, taxes, depreciation, and amortization. So first I got to find the enterprise value. So the enterprise value is the market value of the equity plus the market value of the debt minus cash and cash equivalents. So the market value, and we're not talking about book value, market value of the equity is $12 a share, because that was given to us, the price per share, times the number of shares outstanding. So there's my market value of the equity. Market value of debt, we assume that the debt on the balance sheet is priced at market value, it should be. So we could add the long-term debt and note payable to bank, anything that bears interest. And then I can subtract out the cash and cash equivalents of 77.5. So that gives me my enterprise value, in this case, 696,200. So now I can take that number divided by earnings before interest, tax, and depreciation, amortization, which in this case is going to be the 70,000, and I need to add back in the 41. So, because this 70,000 is EBIT, but then I can add back in the depreciation for EBITDA. So it should be 6.24. It should be the enterprise value. And that's it for this video.